We want you to plan for success. Welcome to Planning Matters Radio.
Hey Peter, it is very good to see you, and today we have a very important topic: how to fight inflation. Of course, inflation was the story of last year. It's still the inflation this year, the story of this year. Now I want to show you some interesting numbers because this is, maybe kind of good news. The US inflation rate dipped to 8.3% in April, marking the first slowdown in 8 months. Some experts say we are past the peak of inflation, but the upward pressures remain. So, Peter, the question is, is there anything that we can do now to guard against inflation?
I unfortunately am skeptical about the insights of those experts on whether we are past the peak. And we're certainly not past the pain by any
Right.
stretch. We are seeing prices increase, it seems like almost on a daily basis. And I know that the CPI has adjusted slightly downward, but the real life expenses that we pay in the grocery store and at the pump and for medical bills or everyday routine expenses
Right.
certainly has not seen any decrease. And
Right.
the
Here's a
fact that
breakdown of
people,
those. Yeah.
yeah, and the fact that these companies have been able to charge prices that people have up to this point been willing to pay doesn't really give any company incentive to drop those prices either.
Right.
And what we're seeing is with the shortage that we have seen, with the supply chain issues that we have incurred, a lot of companies are just now renegotiating prices for their supply chain for the goods that they are receiving, that they in turn sell to consumers. And those renegotiations of the contracts and the storage and the shipping and the trucking and the supplies, those are getting more expensive as well. I mean, we saw Walmart and Target stocks tumble. They missed earnings, but a lot of that was due to the fact that they cannot raise prices fast enough on consumers to offset the cost that they are having to pay to buy more goods to replenish their supplies. And so I'm hoping that we see some type of stabilization in inflation, but I don't see it going away or being a non-issue anytime soon.
All right. Well, it does hurt to go grocery shopping to fill up the car. You are so right. So let's talk about what we've seen though in the markets. We've seen a break in yields as investors move out of stocks and into treasuries. Are there any actions that we should be taking now to guard our investments against inflation?
Well, that's a move that I think is sort of a natural reaction when we see market volatility. No
Right.
one wants to leave the party when everything's going really well, when everybody's having a good time and the stock market is rising, everybody wants to be in it. But as soon as we see volatility in the markets, it's sort of the natural reaction for many investors to try to exit what they think is early, but ultimately, oftentimes it's a little too late and it's kind of just locking in losses. Now, what we are seeing is that with the Fed's approach to controlling inflation, rising interest rates, that the interest rates on borrowing money, for instance, for mortgages, seems to be reacting a whole lot faster than on savings and deposits and investments. I mean, the mortgage rate has almost doubled already this year, whereas the rate on your checking, savings, CD, money market has not seen nearly the increase. Also, the rates seem to be reflecting much quicker for short-term rates than long-term rates. So the 30-year treasury has not adjusted nearly as much or as quickly as like the 5-year rate on treasuries. And so we are nearing that territory of the dreaded inverted yield curve, which has in previous times been a precursor that signaled the potential for recession. Now, there have been times where it has inverted, where we have not seen a following recession as well, but it is one thing that economists do pay attention to. What can we do? Well, there are options out there. The market and inflation do not always coincide in an agreeable way. If we flash back to like the 1970s and early 80s, where inflation was a big factor, the market did not help us to offset inflation during that time. And so we're looking to things like structured notes, defined outcome investing, I bonds are a fantastic option right
Mm-hmm.
now because they do reflect what the Fed advertises as the inflation rate. So as of right now, you can get, as much as anything can be said to be guaranteed or risk-free in the financial world, a rate of 9.62
Right.
from your federal government backed on I bonds. Now, anytime the government gives us something good, they limit how much we can take advantage of. So you can only do $10,000 per year per person. I wish we could do more, but those are the limitations. I don't see inflation going away anytime soon. So while that rate can adjust, I don't see it falling precipitously or dramatically in the
Mm-hmm.
course of the next year or so.
Okay. Well, that was some good actionable advice for, people who have maybe a longer time horizon, but I'm sure that advice is a little bit different for somebody who is in or near retirement. So during this period of high inflation, what should pre-retirees and retirees be doing?
Right. Yeah, it's definitely got to be different because during your earning years, during your working career, hopefully your wages adjust with the cost of
Right.
living. You can negotiate pay raises or work into better, higher paying jobs.
Hmm.
Whereas during retirement, you've got a fixed income and a set finite amount of money on day one. You've got to make it last. Therefore, Aaron, we've got to be proactive. You can't wait until periods of high inflation to plan for high inflation. You've got to plan for higher inflationary periods, even during periods of low and relatively stable inflation. Those are conversations that really a prudent planner, a cautious, experienced advisor is going to have pre-retirement or in the very first planning years of retirement, because costs do go up over time.
Hmm.
That's a fact. That's inevitable. The value, the purchasing power of the dollar has dropped considerably over the years, and that's not going to stop. It's going to continue that trend. And
Right.
so we need to plan for retirement in a way that either has increasing ability to generate more income throughout the years or separate segmentations of money that can be kicked on over time throughout the years, or identifying basically a time optimized portfolio that has now money, soon money, later on
Right.
down the road money, and growth money. And during good periods, we can sort of harvest some of that growth money to supplement those other buckets.
Well, these are really important considerations. And you brought up some specific investment opportunities. If somebody would like your help to design a portfolio that can withstand these periods of high inflation, or some of those, again, hedged equities and structured notes that you mentioned, what's the best way to reach you?
Yeah. Call the office, 919-300-5886, 919-300-5886. You can email me, Peter at RichonPlanning.com. It looks like Rich on Planning. It's my last name. Peter at RichonPlanning.com. Go online, RichonPlanning.com.
All the ways. All right, Peter, thank you.
Always a pleasure, Aaron. Thank you.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookzone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.